Look at the screen. Look at it very carefully. This isn't a backtest. This isn't a simulation. This isn't some what-if scenario from a 2024 Gold Bug forum. This is the reality of the world we woke up to today. Friday, April 24th, 2026. Yesterday, Thursday the 23rd, the silver market didn't just break, it shattered. In a single trading session, silver touched $78.46. Take a second. Let that number burn into your retinas. $78.46. Within the same 6-hour window, the unseen hand of the COMEX slammed the brakes so hard that we saw a collapse back down to $74.12, a $4.34 intraday swing. That is more volatility in one afternoon than we used to see in an entire fiscal year. Most people, the retail normies, the people still checking their 401ks once a month, they're looking at the current bid of $75.29, and they're calling it a healthy pullback. They think the storm is past. They're closing their laptops and going to sleep, thinking the experts have everything under control. They are dead wrong. What happened yesterday wasn't a pullback. It was a structural stress test of a system that is currently on life support. We are standing in the middle of a war room scenario that has been decades in the making, and the fuse was just lit in the Middle East. While you were watching the silver ticker, did you see the headlines from the Gulf? Trump's Hormuz blockade is no longer a campaign threat. It is a physical, naval reality. With the Strait of Hormuz effectively locked down, 20% of the world's oil is trapped. But it's not just about the oil. It's about the Section 232 invocations that followed. We are seeing a total mobilization of national security tariffs. The global supply chain isn't just kinked, it is snapped in half. The physical silver you hold in your hand, if you're lucky enough to have it, is no longer just investment metal. As of this morning, it is a strategic Tier 1 asset. It is the only thing standing between you and the total evaporation of purchasing power as the Fiat system enters its final violent terminal phase. This rejection we saw at $78.46, that wasn't a market finding its level. That was a desperate, coordinated institutional strike to prevent a total limit-up explosion that would have vaporized every short-selling bullion bank on the planet. Gold is screaming at $4,692. It's knocking on the door of $5,000, and silver is the coiled spring that is about to snap back with a vengeance that will leave the Hunt brothers looking like amateurs. We are sitting on the edge of a 48 to 72-hour window that will define the next decade of your financial life. This is the 2026 crisis. The paper ghost is fighting the physical reality, and for the first time in history, the ghost is losing. Today, we aren't just talking about charts. We are talking about the Shanghai Arbitrage that is draining the West dry. We are talking about why the Section 232 impacts on industrial silver procurement are creating a buy-at-any-price panic in the semiconductor and defense sectors. I'm going to show you the math, the cold, hard, terrifying math of the COMEX inventory drain. We are going to look at why the banks are behaving like cornered animals, and most importantly, I am going to give you the 2026 roadmap to survive the Hormuz trap. This is a serious show. I'm not here to give you hopium. I'm not here to pump your bags. I'm here to tell you that the sirens are going off in the halls of the Federal Reserve and the ECB. They can't hide the numbers anymore. When silver swings 6% in a session, while the world is on the brink of a kinetic naval conflict, you don't look at the price, you look at the exit. Welcome back to the Asian guy. If you're new here, understand one thing. This channel is the war room for the real asset revolution. We don't do hype, we do mechanics. We analyze the causal chain from the geopolitical front line in the Middle East to the vault floors in London and New York. Silver is the most misunderstood, most manipulated, and most essential asset on the planet. It is the Achilles heel of the entire central banking complex. And right now, that heel is bleeding. If you want to understand the mechanics of the collapse, not just watch the fire from the sidelines, then you need to pay attention to every second of this Keechban. What I'm about to lay out in this multi-phase briefing is material you won't find on CNBC or Bloomberg. They're still talking about inflation targets while the world is burning. We're talking about survival. We're talking about wealth transfer. We're talking about the end of the great paper illusion. The story of April 2026 is the story of the silver breakout. And it starts with the $78 rejection. They hit us hard yesterday. They tried to shake the weak hands. But look at the volume. Look at the physical premiums. The smart money isn't selling. They're positioning for the next leg, the move to $100, $200, and beyond. Get your notes ready. This is phase 1 of the ultimate breakdown. The crisis is here. The adrenaline is high. The system is failing. Let's go. You want to know why silver dropped $4 in 3 hours yesterday? You want the why behind the what? Then you have to look into the abyss of the paper market scandal. Most people think when they buy silver on an app or through a broker, there's a bar of silver sitting in a vault with their name on it. That is the greatest lie ever sold in modern finance. Welcome to the COMEX Leverage Math. This is the ghost market. As of this morning, April 24, 2026, the ratio of paper claims to physical ounces in the COMEX vaults has reached a level that is mathematically impossible to sustain. We are looking at a leverage ratio exceeding 500 to 1. For every single physical ounce of silver registered for delivery in the New York vaults, there are 500 paper contracts promising that same ounce to 500 different people. Imagine a game of musical chairs where 500 people are fighting for one single chair. That's the silver market right now. And the music? The music didn't just stop. The speakers exploded. Let's break down the mechanics. You have two types of silver in these warehouses, eligible and registered. Eligible is just silver sitting there belonging to someone else. It's not for sale. Registered is the only metal available to satisfy the paper shorts. As we sit here in the war room, the registered silver inventory has been drained to its lowest level in history. We are talking about a structural drain that started years ago but has turned into a vertical drop. Why? Because the Section 232 national security mandates just kicked in. The U.S. government has effectively declared silver a strategic defense metal due to its necessity in the guidance systems of the munitions we are currently deploying to keep the shipping lanes open. Under Section 232, domestic manufacturers, the guys building the missiles, the guys building the satellite arrays for the Hormuz surveillance, are no longer allowed to rely on just-in-time delivery from foreign adversaries. They are being forced by federal law to take physical delivery of every ounce they contract. This is the bank's worst nightmare. See, the bullion banks, the big commercials we see in the Commitment of Traders, COT report, have spent decades playing a shell game. When the price gets too high, like it did yesterday at 78 dollars, they simply print paper silver out of thin air. They sell millions of ounces of silver that do not exist to overwhelm the buy orders. It's a digital ambush. They use the ghost to scare the physical. But look at the math of yesterday's rejection. To drive the price from $78 back to $74, the banks had to dump the equivalent of 2 years of global mine production in paper contracts in a single afternoon. 2 years in 4 hours. In any other market, that's called fraud. In the silver market, they call it providing liquidity. But here is the 2026 twist. The Shanghai Gold Exchange, SGE, is no longer playing along. While the COMEX was trying to slam the price down to $74, the physical price in Shanghai stayed anchored at a massive premium. The Shanghai Arbitrage is now a gaping wound. Smart money is buying the paper ghost in New York for $75, demanding physical delivery, and immediately shipping it east, where the real price, the physical reality, is already sniffing $90. This is why the volatility is so violent. The banks are cornered animals. Every time they short the market to suppress the price, they are increasing their own liability. They are selling more ghost silver into a world that is desperately demanding the physical metal. And let's talk about the Hormuz blockade's impact on this math. Silver isn't just a monetary metal, it's an industrial powerhouse. With the Strait of Hormuz blocked, the risk-off trade usually favors the dollar. But this time is different. The dollar is strong, yes, but silver is becoming unobtainable. Refineries in the Middle East and India are being throttled by energy costs and shipping logistics. The physical floor isn't just moving up. It's being bolted to the ceiling. The banks thought they could use the Hormuz crisis to spark a liquidity panic and wash out the silver longs. They thought you'd see the red candles and run for the hills, but they forgot one thing. You can't build a solar panel or a Tomahawk missile with a PDF of a COMEX contract. This is the inventory countdown. We are watching the mathematics of the drain in real time. If the current rate of delivery requests continues, driven by the Section 232 panic, the COMEX Registered category will hit 0 within the next 60 days. 0. When that happens, the paper price becomes irrelevant. We will move to a force majeure scenario where the exchanges settle in cash because they have no metal. But if you're an industrialist who needs silver to keep your factory running, cash won't help you. You will go to the physical market and pay whatever it takes. That is the moment the paper scandal ends and the price discovery begins. Don't let the $75 print fool you. That is the price of the ghost. The physical is already gone. The leverage is 500 to 1, and the 499 people who don't get their chair are about to realize they've been robbed. The question isn't whether silver is worth $75. The question is, who actually has the metal? In the 2026 crisis, the certificate is a death warrant for your wealth. The bar is your ticket to the next era. Keep your eyes on the delivery numbers. The banks are out of ammo, and the paper wall is starting to crumble. While the Western financial media is hyper-fixated on the $4.34 drop on the COMEX, they are completely ignoring the giant sucking sound coming from the East. If you want to know why the paper price rejection yesterday was a desperate, failing move, you have to look at the Shanghai Gold Exchange, SGE. As of this morning, April 24th, 2026, we are witnessing the greatest wealth migration in the history of the human race. And it's happening through a mechanism called the Shanghai Arbitrage. Look at these numbers on your screen. While the COMEX was fighting to keep silver pinned at $75, so at 29, the physical price at the Shanghai Gold Exchange hit an equivalent of $92.15. That is a $17 spread. For decades, the difference between New York and Shanghai was measured in cents. Today, it's a gaping canyon. Do you understand what this means for the global inventory? It's a physical vacuum. Every bullion dealer, every industrial fabricator, and every sovereign wealth fund with half a brain is buying silver in London and New York at the suppressed paper price, loading it onto planes and flying it to Shanghai to capture that $17 premium. The COMEX isn't just losing silver, it is being cannibalized by the East. This is the Eastern pivot. For the last century, the West set the price of precious metals through the paper ghost system we discussed in Phase 2. But in 2026, the game has changed. China, Russia, and the expanded BRICS Plus nations have realized that the dollar is a weapon, and they've decided to build a shield. With Trump's Hormuz blockade effectively cutting off the primary energy artery to the West, the East has moved to a commodity-first settlement system. They don't want your treasuries. They don't want your digital promises. They want the metal. In Shanghai, silver isn't just a commodity. It is the hard asset collateral for the new petro-yuan trade. While you're worried about the $4 pullback, China is quietly vacuuming the LBMA vaults. They know that in a world of total supply chain collapse, the person who owns the physical metal makes the rules. And here is where the Section 232 impact turns from a domestic policy into a global catastrophe for the West. By invoking Section 232, the U.S. has essentially admitted that it cannot function without physical silver for its national defense. But here's the problem. The U.S. is a net importer of silver. By the time the Department of Defense tries to secure the metal it needs for the new drone swarms and high-frequency jamming arrays required to break the Hormuz trap, they're going to find the shelves empty. Why? Because the Shanghai Arbitrage already cleared the warehouse. We are seeing a coordinated Eastern squeeze. Russia has just announced they are adding silver to their state precious metals fund, Gokran, for the first time in the modern era. They aren't buying paper contracts. They are buying 1,000-ounce bars. They are taking physical possession. They are pivoting away from the paper ghost entirely. The Asian guy leans in, his voice dropping to a cinematic whisper. This is the war room reality. The West is trying to fight a 21st century resource war using 20th century paper manipulation tactics. But you can't short a physical shortage. When the COMEX price dropped yesterday, the physical premiums in the East actually rose. The Eastern markets laughed at the Western rejection candle, and they saw it for what it was, a fire sale on the most valuable asset in the world. Every ounce that leaves the COMEX and lands in Shanghai is an ounce that is never coming back. The East is black-holing the global silver supply. They are preparing for the final reset, where the gold-to-silver ratio doesn't just compress, it collapses. In Shanghai, they aren't looking at 62 to 1. They are already trading as if the ratio is 30 to 1. If you are still holding paper silver in a Western brokerage, you are essentially holding a ticket to a theater that's already on fire and the exits are blocked. The Shanghai pivot is the final signal. The power to set the price of your wealth has moved from Wall Street to the East. While the Asian guy has always told you to watch the mechanics, today I'm telling you to watch the geography. The metal is moving east, the power is moving east. The paper scandal in the West is the dying gasp of a system that no longer has the collateral to back up its threats. Yesterday's $78 high was a Western ceiling, but in Shanghai, that same price was a floor. Within the next 72 hours, we are going to see if the Western banks have the guts to keep selling ghost silver into the Shanghai vacuum. If they do, they are simply subsidizing their own destruction. Stay positioned. Stay physical. The East has already made its move. We need to talk about the Hormuz trap. Most of you are looking at the price of gas at the pump. You're seeing oil spike 30% since the conflict began in February, and you're worried about inflation. But if you're a silver investor, the oil price is just the distraction. The real story, the one that will send silver to triple digits, is the total collapse of the high-tech supply chain caused by the U.S. blockade of the Strait of Hormuz. This is the war room reality of April 2026. The global economy is built on just-in-time delivery, but just-in-time only works if the oceans are open. Right now, they are closed. Look at the mechanics. When Trump's Hormuz blockade went into effect, shipping insurance for any vessel entering the Gulf didn't just rise, it became unobtainable. Lloyd's of London has effectively blacklisted the region. If you are an electronics manufacturer in Japan or a semiconductor fab in Southeast Asia, your energy costs just tripled, but your input logistics just died. This is the trap. As energy prices surge, the Federal Reserve is forced to keep interest rates in the death zone to fight inflation, which keeps the US dollar artificially strong. The banks use this strong dollar narrative as a smokescreen to dump paper silver contracts. They want you to think, oh, the dollar is up, so silver must go down. They want you to ignore the fact that the physical supply chain is snapping. Let's get into the Section 232 data. On April 2nd, 2026, the administration overhauled Section 232 of the Trade Expansion Act. They didn't just add tariffs, they reclassified silver as a strategic defense metal. Under these new rules, the full customs value of any silver-bearing derivative is being taxed at 50%. But more importantly, the government now has the priority authority to commandeer domestic silver supply for national security. Why? Because of the Tomahawk math. He slams the circuit board onto the table. Every single Tomahawk land attack missile being loaded onto those destroyers in the Gulf contains approximately 500 ounces of silver. Every guidance system, every Turcom nav array, and every silver zinc battery in those missiles is a one-way trip for that silver. When those missiles are fired to enforce the blockade, that silver isn't just used, it is vaporized. As of this morning, we are seeing drone swarms being deployed at a scale never before seen in human history. Each of those high-precision drones requires silver-plated connectors and immersion silver circuit finishes to ensure signal integrity in a high-jamming environment. We are literally shooting our silver supply into the ocean. This is the supply chain collapse. While the COMEX paper ghost is trading at $75, the industrial manufacturers for Boeing, Raytheon, and Lockheed Martin are hitting a supply wall. Under Section 232, the government is moving to the front of the line. If there's a shortage of 1,000-ounce bars, the Department of Defense gets them first. The solar panel manufacturers, they get the leftovers. The private mints, they get nothing. This is the bait and switch. The banks drop the paper price to $74 to trigger your stop losses and shake you out of your physical metal. Meanwhile, the military-industrial complex is panicking because they realize that silver mine supply is inelastic. You can't just turn on a new silver mine because there's a war in the Middle East. It takes 10 years to bring a project to production. We are in a deficit reality. 2026 is the 6th consecutive year of a global silver deficit. The World Silver Institute already warned us in February. Physical investment is forecast to rise 20%, but industrial supply is hitting a 4-year low. And that was before the Hormuz trap was fully sprung. If the blockade continues for another 30 days, the just-in-time inventory for high-tech components will be exhausted. We're talking about a total shutdown of semiconductor fabrication in the West. When that happens, silver won't just be expensive, it will be rationed. The Asian guy leans into the camera, his expression grim. Do you see the pattern? The paper market is trying to tell you that silver is worth $75 because the dollar is strong. But the physical world is telling you that silver is priceless because it is the literal nervous system of modern warfare and technology. Yesterday's $78 to $74 rejection was the banks trying to buy time. They need you to sell your physical bars back to the dealers so they can fulfill the priority orders coming from the defense sector. They are using volatility as a weapon to steal your collateral. The Hormuz trap is set. The global supply chain is in a terminal tailspin. The Section 232 mandates are the final admission that the US government knows the cupboard is bare. In a world of missiles versus money, the missiles always win, and the missiles must have silver. In Phase 5, we are going to look back at history, the 1971 reset and the Hunt brothers, to show you why this 2026 setup is 10 times more explosive than anything we've seen before. The paper ghost is about to meet a physical reality that doesn't care about your trading terminal. Don't be the person who sold at $75 because a chart looked scary. Be the person who understands that in 2026, silver is the ultimate strategic asset. Stay sharp. The next 72 hours will confirm everything. They say history doesn't repeat, but it rhymes. Well, in April 2026, the rhyme has become a deafening roar. To understand why yesterday's 7846 print was just a warm-up act, we have to look back at the two ghosts that haunt the halls of the Federal Reserve, 1971 and 1980. If you don't understand these two dates, you are just a passenger on a ship you don't know is sinking. But if you do understand them, you'll see why the 2026 crisis is the inevitable conclusion to a 55-year-long lie. Let's start with August 15th, 1971, the Nixon shock. President Nixon temporarily suspended the convertibility of the US dollar into gold. He closed the gold window. He promised it was to protect the dollar from the speculators. That was 55 years ago. The temporary system of pure fiat money backed by nothing but faith and credit, has now reached its terminal velocity. In 1971, they decoupled the currency from reality. In 2026, with Trump's Hormuz blockade, reality is striking back. The 1971 reset was about exiting the gold standard to print infinite debt. The 2026 reset is about the return to a commodity standard because the debt has become unpayable. When Nixon closed the window, gold was $35. Today, it's $4,692. That's a 13,000% adjustment in the price of the dollar. And yet, the paper ghost sellers yesterday think they can hold silver at $75. Now, let's talk about the Hunt brothers. In the late 70s, Nelson Bunker and Herbert Hunt saw the 1971 writing on the wall. They decided to corner the silver market. They drove the price from $2 to $50. The mainstream media calls them manipulators. But in this war room, we call them the first people to realize the paper dollar was a scam. But here's the critical difference between the Hunt brothers and today. In 1980, the Hunt brothers were just two wealthy individuals using leverage on the COMEX. They were private citizens fighting the deep state of the banking system. When the COMEX changed the rules, liquidation-only trading, they crushed the Hunts. In 2026, the Hunt brothers aren't two guys from Texas. They are sovereign nations. They are the BRICS Plus alliance. They are the central banks of the East. When the COMEX tried to pull their paper ambush yesterday, they weren't fighting speculators. They were fighting the Shanghai Gold Exchange. You can't change the rules on a sovereign superpower that is currently vacuuming your physical metal through the Shanghai Arbitrage. The Asian guy points to a chart of the gold to silver ratio. Look at this ratio. In 1980, when the Hunts were at their peak, the gold to silver ratio collapsed to 17 to 1. Yesterday, even with silver at $78, the ratio was sitting at 62 to 1. Do you see the discrepancy? If we were at the Hunt brother levels of market tension today, with gold at $4,692, silver wouldn't be $75. It would be $276 per ounce. The 1980 move was a speculative bubble. The 2026 move is a physical correction. In 1980, people were buying silver because they wanted to get rich. In 2026, people and governments are buying silver because they want to survive. This is the Section 232 paradox. In 1971, Nixon took us off the gold standard to allow for infinite expansion. In 2026, the U.S. government is using Section 232 to effectively nationalize the silver supply for defense. It is the Nixon shock in reverse. Instead of saying, we won't give you gold for your dollars, the U.S. is now saying, we are taking the silver because your dollars can't buy it anymore. We are moving from an era of financial assets back to an era of real assets. The 1971 to 2026 cycle is closing. The debt slaves are waking up, and they are realizing that the paper silver they hold in their accounts is just a digital hallucination. Let me be precise. The Hormuz trap is the modern version of the 1973 oil embargo, but with a 2026 twist. In the 70s, we had the Petro-Dollar to save the system. We made a deal with the Saudis to price oil in dollars, but that deal expired. The Petro-Dollar is dead. The commodity dollar doesn't exist. What exists now is the silver missile economy. You can't print silver. You can't policy adjust a supply deficit. Yesterday's $4 rejection was the bank's attempt to repeat their 1980 victory. But they are fighting yesterday's war. They are trying to use Silver Thursday tactics against a world that has already pivoted to a hard asset reality. Every major monetary reset in history has been preceded by a massive spike in the price of precious metals. 1971 was the setup. 1980 was the warning shot. 2026 is the reset itself. When the COMEX inventory hits zero, as we analyzed in Phase 2, the 500 to 1 leverage will explode. The registered silver will vanish. And at that moment, we will see a price gap that will make the Hunt brothers move look like a minor market hiccup. The war room advice? Don't look at the $75 ticker. Look at the 55-year arc of history. We are at the end of the line. The paper ghost is being exercised by the physical reality. In Phase 6, we are going to dive into the mathematics of the drain. I'm going to show you the exact numbers behind the inventory countdown and why the force majeure is no longer a conspiracy theory. It's a scheduled event. History is a circle, and the circle is closing on the bullion banks. Stay patient. Stay physical. The 2026 roadmap is just beginning. We've talked about the paper ghost, the Shanghai vacuum, and the Hormuz trap. But now we need to talk about the only thing that actually matters when the system breaks, the mathematics of the drain. In the war room, we don't care about feelings. We don't care about what an analyst on CNBC expects. We care about available inventory. And as of Friday, April 24th, 2026, the inventory math for the Western world has reached what I call the 0-point event. Let's look at the COMEX Registered category. Remember, registered is the only silver that is actually for sale to satisfy paper contracts. In 2022, we had over 100 million ounces in the registered category. By late 2025, that number had been hacked down to 30 million. But look at the data from this morning. Following the $78 spike and the massive delivery requests triggered by the Section 232 mandates, COMEX Registered silver has plunged to under 8 million ounces. 8 million ounces. To put that in perspective, the global electronics industry alone consumes that much silver every few days. We are no longer talking about a tight market. We are talking about physical extinction. Now, look at the paper to physical ratio. Open interest on the COMEX is currently sitting at roughly 800,000 contracts. Each contract represents 5,000 ounces. That is 4 billion ounces of silver promised on paper. We have 8 million ounces of registered silver to back it up. Do the math with me. That is a leverage ratio of 500 to 1. If just 0.2% of the paper contract holders, 1 out of every 500 people, decide they want their silver delivered to their doorstep instead of a cash settlement, the COMEX is bankrupt. The exchange is empty. The vault doors are swinging in the wind. Why is this happening now? Why didn't it happen in 2024 or 2025? 2 words: priority allocation. Under the new Section 232 impacts, the U.S. Department of Defense and designated national security fabricators have been granted super priority status. When silver leaves the vault, it isn't going to the longs on the COMEX. It's being diverted under federal law directly to the production lines for the Hormuz interception swarms. The government is essentially front-running every retail and institutional investor in the world. They know that with the Strait of Hormuz blocked, the supply of byproduct silver from global mining operations is being throttled. Energy costs for refiners in Europe have spiked 400% this month. They can't afford to refine the metal, and even if they could, the shipping lanes are a war zone. This is the mathematics of the drain. Annual mine production: 820 million ounces, and falling due to energy costs. Industrial demand, PV, EV, defense: 650 million ounces. Investment demand, 300 million ounces. The result, a structural deficit of over 130 million ounces a year. We have been eating into the above-ground stockpiles for 6 years, and yesterday at 78.46, the market finally realized that the cupboard is bare. The rejection you saw wasn't sellers entering the market. It was the exchange refusing to let the price reflect the shortage. This leads us to the most dangerous phrase in finance: force majeure. A force majeure is a legal clause that allows an exchange to cancel its contracts because of unforeseeable circumstances. In plain English, it means, we don't have your silver, so we're going to give you a check for the paper value and tell you to go away. But here is the 2026 trap. If you get a check for $75, the paper price, but the physical silver at the local coin shop is selling for $150 because of the shortage, you didn't just get settled, you got expropriated, you got robbed. The inventory countdown is at T-0. The LBMA in London is reporting unprecedented outflows to the east. The Shanghai Arbitrage we discussed in Phase 3 is the giant pump that is sucking the last remaining ounces out of the Western system. The banks are desperate. They are using the Trump blockade volatility to try and scare you into selling your physical bars back to them. They need your 100-ounce bars to melt them down and turn them into industrial grain for the defense contractors. They are literally trying to shake down the retail stacker to keep the military-industrial complex running for 1 more week. Look at the clock. The Asian guy points to the ticking countdown. The mathematics are immutable. You cannot print silver. You cannot policy adjust your way out of a physical drain. Every day that silver stays below $100 while the deficit grows is a gift to the people who understand the force majeure scenario. When the COMEX finally declares cash settlement only, the physical price won't just rise, it will gap. It will move from $75 to $150 to $300 in a series of overnight resets. There will be no entry point. There will be no dip to buy. There will only be those who have and those who have not. Yesterday's volatility was the sound of the machine grinding its gears. The $78 to $74 swing was the inventory drain hitting the bottom of the tank. The banks are out of metal and they are almost out of time. In Phase 7, we are going to look at the price targets, $300, $600, in the 2026 roadmap. I'm going to show you exactly how this resolves when the physical reality finally breaks the paper ghost once and for all. If you aren't holding it, you don't own it. And in 2026, if you don't own it, you don't exist. Stay patient. The math is on our side. We've gone through the blood, the guts, and the mechanics of this market. We've analyzed the Hormuz trap and the COMEX inventory drain. But now we address the question that keeps the paper ghost sellers awake at night and the war room members focused: where does the price actually stop? Most analysts are afraid to give you a number. They'll talk about moderate growth or reaching the 2011 highs. They're still thinking in a 20th century mindset. They are looking at a world that no longer exists. In the world of April 2026, a world of Section 232 nationalizations and a global energy blockade, the old price targets are irrelevant. Today, I'm going to give you the 2026 roadmap. I'm going to show you why the numbers $300 to $600 aren't just projections. They are the mathematical destiny of a metal that has been suppressed for 100 years. Let's talk about the gold to silver ratio compression. This is the primary driver. Gold is currently sitting at $4,692. In every major monetary crisis in history, the ratio between gold and silver collapses as silver, the restless metal, plays catch-up. At a ratio of 15 to 1, the historical monetary norm for over 1,000 years, silver is a $312 asset. At a ratio of 8 to 1, which is the physical ratio of how silver actually comes out of the ground, silver becomes a $586 asset. But Asian guy, you say, that's a 600% move from here. How is that possible? It's possible because we are moving from a speculative price to a scarcity price. In the past, the price was set by what traders thought silver was worth. In late 2026, the price will be set by what a semiconductor fab is forced to pay to keep from going bankrupt. Here's the 2026 roadmap, the 3 stages of the Great Re-rating. Stage 1, the force majeure gap, May-June 2026. As we speak, the inventory countdown we analyzed in Phase 6 is hitting the red zone. Within the next 60 days, we expect the first major Western exchange to settle a silver long in cash because they cannot find the physical bars. This is the ouch moment. The moment the public realizes the ghost has no body. This will propel silver past the $100 psychological barrier. At $100, the silver market enters a limit-up phase where there are no sellers, only buyers. Stage 2, the industrial panic and section. 232 fallout, July-September 2026. With the Hormuz blockade dragging into its 6th month, the global supply of byproduct silver from copper and lead mining will have collapsed. The U.S. government, using its Section 232 priority authority, will begin seizing domestic production. If you are a private solar company or an EV manufacturer, you will be forced to the gray market to find metal. We will see shadow premiums, where silver trades for 200 pluses in private transactions, while the paper price is still trying to catch up. This is the buy at any price phase. Stage 3, the final monetary reset, October-December 2026. This is when the BRICS plus nations finalize their new settlement unit, backed by a basket of commodities, with silver as a core component. The Shanghai Gold Exchange will officially decouple from the COMEX. The Shanghai Arbitrage will end because there will be no silver left in the West to move. At this point, the gold to silver ratio will snap to its geological limit of 8 to 1 or 10 to 1. This is how we reach the $400, $500, and $600 targets. The Asian guy leans in, his expression intense. Do you understand the magnitude of what I'm telling you? We aren't talking about a bull market. We are talking about the remonetization of the most essential industrial element on Earth. Yesterday's $4 drop from $70 to $. That was a blip on the radar. The banks are trying to prevent you from seeing the roadmap. They want you focused on the wiggle while they prepare for the gap. While they are shorting the paper market to keep the official price at $75, they are quietly using their own Tier 1 capital to secure physical offtake agreements with miners at much higher prices. They're telling you to sell while they are buying the physical reality behind your back. The roadmap for your positioning. If you are waiting for a dip back to $30, you are waiting for a world that has been incinerated by the 2026 crisis. The dip happened years ago. Every day that silver stays below $100 is a gift from the paper ghost that is about to expire. In the war room, we don't trade for 10% gains. We position for generational wealth transfer. When the ratio compresses, the leverage in the silver miners, the ones that actually have silver in the ground, will be legendary. We are talking about 10 baggers, 20 baggers, and beyond, but you only get those gains if you have the titanium hands to hold through the $4 rejections. Look at the Hormuz trap. Look at the Section 232 mandates. Look at the Shanghai vacuum. These aren't opinions. These are the structural pillars of the $600 silver thesis. The world is running out of silver, and the world is currently entering a kinetic conflict where silver is more valuable than oil. The roadmap is clear. The destination is set. The only question is, will you be at the finish line, or will you be left at the starting block holding a handful of paper promises? In our final phase, we are going to discuss the final exit strategy. Because getting rich is only half the battle. Staying rich during a global currency reset, that's where the true war room masters are made. I'm going to show you how to exit the miners and rotate back into the new reality. Stay patient. The $300 level is a mathematical certainty in the current trajectory. Don't let the ghost scare you out of your future. We have survived the storm. We have decoded the paper market scandal. We have tracked the Shanghai vacuum and mapped the Hormuz trap. We have watched silver touch $78 and gold hover at $4,700. But now we reach the most critical chapter of the entire 2026 roadmap. This is where the amateurs become victims and where the war room becomes the new elite. Because the hardest part of a revolution isn't winning the war, it's surviving the peace. Today, we talk about the final exit strategy. Most people spend their whole lives asking, when do I sell? That question is a relic of the old Fiat mindset. In the world of April 2026, a world of Section 232 nationalizations and a global energy blockade, the old price targets are irrelevant. Selling your physical silver for digital dollars right now is like trading a life raft for a stack of wet newspapers. Listen closely. This is the Great Rotation. When we hit our targets, when silver reaches the $300 to $600 range and the gold to silver ratio is screaming at 10 to 1, you aren't looking for an exit to the dollar. You're looking for an exit to cash flowing reality. Step 1, the miner liquidation. If you followed our strategy and held high quality silver miners or royalty companies, you are currently sitting on 10x, 20x, maybe 50x gains. These are paper assets. They serve their purpose as a leveraged slingshot. But as the 2026 crisis reaches its terminal phase, the systemic risk of the equity markets will become unbearable. When the miners hit our price targets, we harvest those gains. We take the paper profits and we immediately, within hours, convert them into physical assets that the government cannot delete with a keyboard. Step 2, the physical to productive pivot. This is the secret of the world's oldest families. You don't hold the silver forever. You hold the silver until it can buy you productive land, energy infrastructure, or essential businesses. Imagine the scenario. It's late 2026. The dollar has been devalued by 80%. A 500-acre farm that used to cost $5 million now costs 2,000 ounces of silver. In 2024, that same farm would have cost you 200,000 ounces. That is the wealth transfer. You use the scarcity value of your silver to buy the productive value of the new economy. You exit the metal into assets that produce food, energy, and shelter. You become the landlord of the new reality. Step 3, navigating the Section 232. Final grab. As silver reaches its peak, expect the government to get desperate. We've already seen them use Section 232 to prioritize industrial supply. In the final phase, they may attempt a national silver windfall tax. The war room strategy is simple: anonymity and geography. This is why we've spent so much time discussing the Eastern pivot. Ensure your physical holdings are diversified across jurisdictions. If the West tries to tax the boom, your presence in the Eastern vaults provides the shield. The Asian guy leans back, a faint, knowing smile on his face. Let's bring it home. Thursday, April 23rd, 2026 was a warning shot. That $4.34 drop was the bank's last-ditch effort to keep you in the paper cage, but you saw through it. You understood that a world with a blocked Strait of Hormuz and a $4,700 gold price is a world that has already moved past the point of no return. The fiat system is a ghost. The COMEX is a hollow shell. The Section 232 mandates are the white flag of a dying empire. What we are documenting on this channel is the greatest financial reset since 1971. But this time, the little guy has the blueprint. You have the mechanics, you have the data, and most importantly, you have the patience. The next 72 hours will be volatile. The next 72 weeks will be historic. Closing statement. I don't care if silver goes to $72 tomorrow or $172. I care about the structure. The structure is broken. The physical supply is gone. The math is absolute. Stay in your war room. Keep your physical bars close and your conviction closer. We are moving toward a world where value is no longer a number on a screen, but the weight of the metal in your hand and the depth of the soil under your feet. The Asian guy will be here, documenting every step of the collapse and every milestone of the boom. We are the survivors. We are the architects. Subscribe if you're ready for the $600 reality. Comment physical below if you're holding through the paper storm. The 2026 crisis is just getting started, and so are we.